Good day to you, wherever you are in the world. My name is Dr. Leon Perlman. I'm at Columbia Business School in New York. It's early morning here, and good morning, good afternoon, good evening to you, wherever you are in the world. We're going to talk about trends in anti-money laundering and customer due diligence in digital financial services, presented by Professor Louis De Coker, who is currently in Melbourne, Australia. Before we begin, we'd like to just see who everybody is online. There's a poll you should see, and if we could take a minute or two just to indicate where you're from. So I'll give that a minute or two.
Leon, the poll is closed now.
Oh, okay, great. Okay, so the agenda today, I want to give a quick overview of the Digital Financial Services Observatory, which is the host of this webinar. Then we're going to have a live webinar from Professor De Coker, about 45 minutes. Then a live Q&A, so you can send questions to the host moderator. And then after the Q&A, there's an optional quiz. It's a short 10-question multiple choice quiz. After the webinar and the Q&A ends. So look out for the quiz link in your email, and definitely check your spam folder. The link is live for 2 hours only for certificate purposes. We'll get into the certificate. So just about the observatory, that's the website. So if you're registered, you've seen that. It's been up and running for about almost a year and a half now. And these are our activities. We have a legal and regulatory database of digital financial services, model laws and regulations. We have our annual DFS and Emerging Payments Summit, which is on June 8th and 9th in New York, which you're very welcome to come to. Webinars and roundtables, commentaries and analysis of new laws and regulations, and we have a lot of close cooperation with a number of participants around the world, including regulators, academics, and donors. So these are the webinars we hold. The next one is June 1st. On digital identity, followed by another one on mobile application security on June 6th, and then again in the conference on June 8th and 9th. And those who attend the webinars can earn that certificate of attendance in front of you. You need to attend a minimum of 6 webinars and get 60% for the quiz for each post-webinar live quiz. So the quiz, as I said, is only open for 2 hours post the webinar. So if you want the certificate, you have to take the quiz after the webinar. You can't, if you take it after the 2-hour period, it doesn't count for certificate purposes. So if you do want to pass the quiz today, you really need to take note, look at the slides and listen to the content. All the answers will be in the slides that are presented, so please pay diligent attention. So over to Professor Louis De Coker. He's a professor at the La Trobe Law School in Melbourne. He's well known in the AML space. His research of the past few years has focused on managing the relationship between financial inclusion, AML, and CTF objectives, especially in relation to customer data. We're very, very happy to have Louis. He is a major expert in the field, and I think you'll really enjoy his presentation. So over to you, Professor De Coker in Australia.
Dr. Perlman, thank you for that very kind introduction. Ladies and gentlemen, good morning, good afternoon, good evening to all of you around the globe. I've included an early morning picture of my beautiful home city, Melbourne, just in keeping with the timelines of New York and early morning in New York. Our topic I hope, is as bright as the city skyline. Trends in anti-money laundering and customer due diligence in digital financial services. I'm proposed to discuss three broad themes. This seminar I view as somewhat foundational in relation to the two seminars that will follow on digital identity and then on cybersecurity. I'm trying to provide the framework, and therefore we will spend a bit of time on the Financial Action Task Force, the FATF, and its risk-based approach, because it's incredibly important to understand that, to understand where the trends in digital financial services and customer due diligences are leading. But it's also important to understand the cybersecurity risks. So I'll be laying some of the foundation linked to both the digital identity discussion, where data and data protection is so important, and that in turn linked to cybersecurity. Now, that by way of introduction. Let's start with the Financial Action Task Force, or the FATF, often also referred to as FATF or FATF, depending on the region that you're from globally. Now, the FATF is the global intergovernmental standard-setting body for three broad themes: anti-money laundering, dealing with proceeds of crime; combating of financing of terrorists, who can be financed either from proceeds of crime or from money earned legitimately; and proliferation financing, referring there to weapons of mass destruction. The proliferation financing angle was a focus area that came late to the FATF. As a result, the acronym that's generally used is AML, CFT, implying PF, but just to save time, not including PF generally. Now, the standards that the FATF sets are called the recommendations. 40 recommendations because they drafted 40 recommendations in 1990, which then developed into the foundational set, broadened and expanded with another 9 in respect of terror financing, and then when they were revised in 2012, reverted again to the number of 40. Now, they are called recommendations, but these are some of the most binding, non-binding international standards globally. They are endorsed by more than 190 jurisdictions who have subscribed to these standards and have actively reformed or are in the process of reforming their laws in accordance with these standards. One of the important mechanisms of the FATF to ensure that the standards are being adhered to is a system of evaluation of countries, also including evaluation of how countries are regulating and supervising their regulated AML, CTF regulated institutions that mainly comprise financial institutions, but also include a few professions and designated businesses. But in the main, countries are vetted and publicly assessed, with public reports being released on the soundness of the AML CFT systems, and I'll point to the implications of that in a couple of slides. Now, with the 2012 revision of the recommendations, the FATF introduced a mandatory risk-based approach, both to AML CTF regulation by countries and to compliance by regulated institutions. Essentially, this means that countries need to undertake national risk assessments to inform the shape of the AML CTF laws, They need to determine where their main risks are, and they need to make sure that their laws cover those risks. And the institutions that are regulated also need to undertake institutional risk assessments of their products, their services, their customers, and they need to fashion their compliance responses to the AML/CTF laws in line with their risk assessment results. Now, at the heart of what financial institutions need to do lies this concept of customer due diligence. This is often referred to as KYC. Unfortunately, that terminology is confusing. In fact, the FATF switched terminology. It used KYC in the past until 2003, and then it switched to customer due diligence. KYC, on the other hand, has made a comeback. But whereas we now know from the FATF standards what customer due diligence entails, it is important whenever KYC is used to determine precisely what the user means by KYC, because often it is used to refer to what is now the first element of customer due diligence, and that is identification and verification of the customer's identity. The second element, which is of less relevance to financial inclusion directed digital financial services, is establishing beneficial ownership. That is, for example, the ownership that is exercised through a third party who is often presented as the customer, although the customer is actually a person behind that individual. So this is, for instance, in an inclusion context, we could come across it where a mother or father is the actual owner of an account, and as a result of literacy or technological barriers, the account that they control is opened by one of their children and operated by the child on behalf of the parent. So that's the concept of beneficial ownership. The third element of CDD is determining the purpose and intended nature of the relationship. Now, generally in a financial inclusion context, the FATF has made it easier by saying if it is a deposit product, then you can deduce from the nature of the product what the intended purpose and nature of that relationship is going to be. And lastly, very importantly, monitoring. You need to conduct ongoing customer due diligence, so you need to make sure that your customer information is fresh and up to date, and you need to look at the transactional patterns of your customer to ensure that it matches the expected profile that you had in mind of a customer based on the information that you have of that customer. So that by way of introduction to the concept of customer due diligence. So how does this and the risk-based approach come together? At an institutional level, when you perform your institutional assessments, you will be able to identify certain customers that have a higher risk profile, and in this case, we're speaking about money laundering and terror financing risk. So it means there's a higher risk that they may handle proceeds of corruption or proceeds of another crime, or may be handling funding of terror organizations. But you will hopefully also identify customers that pose a lower risk. And then you may identify products and customers that pose possibly a low risk, essentially a negligible risk. Now, for customers with a higher risk profile, the FATF requires you to implement enhanced due diligence measures. So to do more to mitigate that risk than you would do, for instance, in relation to normal standard customers. In respect of those posing a lower risk, there you may be given the option by national legislation to simplify due diligence measures. Enhanced due diligence when there's a higher risk is always mandatory. It's compelled. Simplified due diligence may be allowed by the country's laws, and if allowed, is optional for the institution. The low risk possibility is interesting and important because in certain cases, and they must be strictly limited cases of proven low risk, where there's really strong grounds to believe that the product poses a very low risk of criminal abuse, countries are allowed to exempt either the product or aspects of the product from the AML-CTF footprint of the law. Now, that could also be very helpful in respect of financial inclusion products, and we will come across an example of that in Mexico a little bit later in this discussion. I want to lift out, in terms of the risk-based approach, recommendation 15, because that recommendation deals specifically with new technologies, and I've printed it for you on slide 13. FATF, if we go back into the history, was actually fairly technophobic and was very sensitive about risks posed by technology. We'll end on a far more positive note in relation to the FATF and technology, but some of that concern is still visible in Recommendation 15 that requires countries and institutions to do specific risk assessments in respect of new products and new business practices, including new delivery mechanisms, and also the use of new or developing technologies for both new but also for pre-existing products. So very important to DFS. This recommendation requires specific risk assessment of new products prior to their launch, or new business practices, or the use of new or developing technologies. And then it is important, once the risk assessment has been done, to have a very well-grounded and argued set of risk mitigation measures to respond to the identified risks. Now, in relation to new technologies and especially new payment methods, the FATF also issued guidance. And if you're specifically interested in this topic, I really urge you to read the FATF's risk-based guidance on prepaid cards, mobile payments, and internet-based payment services issued in 2013, because it will provide you with a far deeper understanding of the FATF's thinking. For example, they've lifted out a range of specific risk factors of concern to them. Firstly, non-face-to-face relationships and the anonymity that may accompany that. Again, so important to digital financial services. Geographical reach, methods of funding, access to cash, and then segmentation of services. Now, I'll quickly run through them. The thinking is, the fact that the service is non-face-to-face provides possibilities of anonymous usage. Whether that is relevant in respect of your product depends on how the CDD has been designed in relation to your product. Geographical reach. If the product is limited to national usage and does not allow cross-border usage, it's regarded as lower risk compared to one that does have a cross-border reach. Methods of funding and access to cash. Any possibility of allowing cash to enter the system or to be extracted from the system, if not appropriately controlled, also adds risk. and then segmentation. If there's a fragmentation, as we normally find in digital financial services, across financial services and telecommunications providers, so that there's a risk that there isn't a single party in control with a total holistic overview of the transactional chain, then that introduces risk. If, on the other hand, it's divided, but there is such central control, then the risk could be estimated as low. So it provides us with an idea of the factors that the FATF has in mind, and also how they want anyone performing a risk assessment to think about those factors. Now, if we go back a little bit further, the World Bank also produced factors in the late 2000s. They worked with anonymity, so linked again with non-face-to-face relationships, but also rapidity, the fact that transactions are so fast if they're digital, elusiveness, the fact that so much of identity can be hidden in the transactions and they may be difficult to trace, and also poor oversight, again, somewhat linked to segmentation. And many risk assessments reflect some of those elements, but these factors identified by the FATF are particularly relevant and important to take note of. Now, just in conclusion, we can't conclude an introduction to the risk-based approach without at least touching on the de-risking problem related to the risk-based approach and responses to risk. Now, de-risking in this context has been used to refer to the large-scale termination of bank accounts. Basically, the closing of bank accounts linked to a number of higher risk types of providers. Money remittance providers have been hit, correspondent banking relationships have been impacted, charitable organizations, especially those that operate in conflict zones, have been affected, foreign missions of some countries, even of the Vatican, has been impacted, foreign political leaders, PEPs, because they are indicated as higher risk by the FATF recommendations, and then again tying back to digital financial services, fintech companies, especially those that dealt in or provided products linked to cryptocurrencies, have also had banks closing their accounts. Now, why has this been happening? A variety of reasons. The FATF has been looking into it since 2014. The Financial Stability Board has been very active in respect of correspondent relationships and have now broadened their footprint to remittance services too. It's complicated. At the heart of it lies concerns about risk and profitability. Money laundering risks, in order to respond to them once they're identified, requires measures that are often costly. They may also be relatively costly in respect of smaller customers where the compliance costs simply renders the business with that customer unprofitable. And in cases where it may still be profitable, where the money laundering risks or reputational risks of associating yourself with a specific sector or type of business may become unpalatable for banks. Now, this sensitivity to risk has been driven by a number of different concerns. Certainly, fines imposed on banks for compliance failures, many of them non-AML CTF related fines, have led to increased sensitivity to risk, but so has the global financial crisis. And the crisis has also led through the Basel requirements to a reappraisal of relationships to ensure higher profitability of banks in particular. And then we just have the general complexity of regulation, of requirements of banks, in a sense, in relation, for instance, to remitters. Banks feel that they have to act as the supervisors of remitters because remitters aren't properly supervised by countries, and they are held liable if any money that's problematic may pass through remitters. Or in respect of digital financial services, there is a far greater concern. There is also pushback from industry saying banks are closing accounts in areas where banks compete, but no grounds have yet been found by any competition authority internationally to take action against de-risking on the basis of anti-competitive behavior. But this is all part of the risk thinking, and if we consider digital financial services from an AML perspective, it is important to bear this in mind. Now, with that as background, let's turn to the trends in digital financial services. In this regard, I want to lift out, in particular, three broad categories for discussion. The one is tiered customer due diligence, because it's important to understand that, to understand what's happening with eKYC, SIM card registration, and then eKYC before I'll conclude with a few more general matters. Tiered customer due diligence. What does this mean? This is a way of regulating customer due diligence where countries take the lead by enshrining it in laws, or where institutions respond by capturing this even without a statutory framework, as long as they're allowed to do it in their compliance practices. Basically, it means that a range of product functionality is created, and across that range, linked to increased functionality, are different levels of customer due diligence, starting at the most basic level with very basic customer due diligence, which is cheaper to administer, but is also easier to meet for people who are unbanked and assist them to gain access to the financial system. Now, this approach was first adopted by South Africa in 2002 under its regulations under the Financial Intelligence Center Act. The first attempt of South Africa was not particularly successful. It learned from that experience and then improved their system in 2004. The 2004 system was far more successful, and Mexico took note of it. South Africa had a two-tier system. Mexico rolled out a three-tier system. And today we find a three and even a four-tier system proliferating internationally. A number of different countries now benefit from having tier-based systems. India and the Philippines, China is a good example, Guatemala also, of tier-based systems. Mexico, interestingly enough, was very bold from a regulatory perspective, because they created tiers that allowed the first level of basic products not to require identity verification. Now, if I can take you back to the FATF and the concept of customer due diligence, you may recall the first line, the first element of customer due diligence is identification of the customer and verification of the customer's identity. Mexico did not attempt to simply simplify customer due diligence. They use that last possibility of a low-risk exemption, if you recall the slide on the risk-based approach to CDD. And they argue that they have proven grounds that the product is designed in a manner that does not lend itself to general abuse, and therefore, under the exemption, they can create this specific first level. But the other countries have generally only simplified the due diligence and retained elements of identification and verification. In terms of this idea of the tier-based approach, it's also relevant to consider India and the Philippines, for example, that allowed small, restricted financial inclusion products to be opened by customers without the necessary identification documentation, provided that they apply for it and receive it within a specific set period. What is also important to bear in mind in respect of digital financial services is SIM card registration. Now, SIM card registration has proliferated over the past 8 years, especially in developing countries, requiring, basically enforcing compulsory mobile phone SIM card registration. But the SIM card registration processes are very similar to AML-CTF identification and registration processes. Unfortunately, it's not been designed that way in many countries because two different regulators deal with these issues. And the telecommunications regulators that rolled out SIM card registration did not necessarily look to the financial requirements applying to access to a bank account, for example. As a result, it actually gave rise to a two-tier process that could really impede access to financial services, where, for instance, the banking process is simplified, but the SIM card registration process still requires standard documentation that unbanked people may not be able to easily provide. However, where these two processes are aligned, it gives rise to a range of possibilities to simplify financial customer due diligence based on SIM card related processes. Now, with that in mind, let's turn to eKYC. So for many developing countries, obviously identity verification is a major inclusion challenge. Many developing countries just lack a comprehensive national identity system. Many of those who have a system do not cover the vast majority of the population. Currently, the World Bank's estimate is that 1.5 billion people globally lack documentation or data to prove their identity, but this is changing. And it's changing using biometrics. And where such national ID systems are developed, it allows intriguing possibilities for electronic identification and verification. Now, on this point, I just need to mention, we've had electronic verification with us in digital financial services for quite some time, where, for instance, countries, Malawi was one of the first that allowed an agent to take a photograph of the hard copy of the identity document and send the copy along digitally with a short statement that they cited the original. eKYC, as it's currently used, however, bypasses the documentation and specifically leverages off the government-held biometric identification data. Pakistan has been one of the leaders in this regard because they have an extensive biometric ID system managed by NADRA, the National Database and Registration Authority, which provides an online verification system. where financial institutions can verify the identity of a customer for CDD purposes against a fee. And we find that most of these models have a fee element linked to them. Now, this has been available for quite some time. In 2014, all new and all existing SIM cards were also required to be biometrically verified and linked to the customer's NADRA identity. So that brought the SIM cards into this framework. And in 2016, this was broadened to provide permission to all providers to remotely open the most basic bank accounts linked to biometrically verified SIM cards, but requiring the customer to make the first deposit in person. A very interesting model in Pakistan, one that has been challenged by the relatively high fees charged by NADRA to access their data. The fees have been dropped, but apparently this is problematic still for many of the smaller models. India, on the other hand, has a very interesting model in its own right, with many of the similar elements, but working slightly differently. Our system rolled out in 2009, with now more than 1.1 billion Aadhaar numbers issued. The Indian system also allows eKYC for both SIM card verification and also for AML-CFT identification. And essentially, the customers scan a fingerprint, and the agent then obtains identification verification based on that fingerprint from the UIDIA, the Unique Identification Authority of India. And if they match the fingerprint with the data that they have, they can actually release the customer's biographical details. That's proof of identity, the address, the email number, and the mobile number to the provider, automatically filling out those customer information parts of the enrollment form. Now, one of our participants have just sent in that Bangladesh is also heading this way. Thailand also has a similar system. This is clearly the way of the future. Very, very exciting developments. Now, at the heart of eKYC models lies the struggle to gain certainty about digital identity, verifying and authenticating identities in a digital environment. And what we find developing around the government systems are governments stepping up to the plate to provide the verification based on these extensive national investments in national identification systems. But we also find very interesting private sector developments about digital identity. And that will specifically be addressed by Paul Macon in the next workshop that will be presented by the laboratory. Now, digital identity has specific challenges that it must meet. One is the verification of claim documents, data, or identities. The eKYC models we've just looked at have governments that provide that authentication service. But where you lack that government, you need someone else as an auditing body or a verification body that can step in and that can verify that that data or that document is actually linked to the specific person. And then furthermore, the private models also struggle with user sophistication. All of these models have give rise to security questions, but clearly there are very important possibilities inherent in eKYC for the future of financial inclusion and financial integrity. a very important barrier to be crossed is appropriate data protection and appropriate data governance and privacy. All of these models are data rich. We know in respect of Aadhaar in India that data breaches have occurred, not on the side of government, but on the side of agents. We know that the privacy usages by the government is currently being considered by the Indian Supreme Court. We know that in terms of digital financial services and social media, there's increased analysis of data and collection of customer data for alternative credit models. We also very aware of what China is doing in respect of social credit scoring and building public trust models for all citizens. And it really requires important attention now that we have some technological solutions to also solve the problems that we are facing regarding data and data protection. Now, on that note, I want to move to the last and concluding comments. Public-private partnerships. What we've seen to date is a confrontational enforcement relationship between governments and institutions, financial institutions. And if you just look at fines, and those are fines imposed by US regulators in relation to anti-money laundering breaches, you can see huge escalation, highly confrontational, highly problematic, because that is the approach that also fed the whole de-risking move. But what we're seeing now is a dawn of a new era of collaboration. The confrontational approach was highly destructive, also in terms of just the general information sharing by institutions with government. But I believe there are promising signs of change in the UK, in Australia, in Singapore too, where anti-money laundering authorities and group compliance officers of banks are starting to work together in task teams, which makes sense because this is all about intelligence gathering to enable societies to act against criminals. This is not primarily about compliance. Now, a very important and positive development, especially this week, the FATF has also started to reach out to the fintech and the regtech community to find out what they may be able to do for the regulated community, but also for AML/CTF regulators. And in fact, there will be a seminal meeting this week in Silicon Valley in San Jose of the FATF and the fintech regtech community. I think this is very important, very positive, and an incredibly positive trend from a digital financial services perspective. Now, on this note, I've reached my 45-minute closure indication. And on this note, I'd like to hand the microphone to Dr. Pullman for any questions.
Thank you, Professor Ducoka. That was great, very rich presentation. At this stage, I'd like you to open up the room to questions. If you could perhaps send it on the chat, and Professor Ducoka and I will read them out as they come. So you're very welcome to send questions.
Thank you, Leon. And I also noticed while I was speaking, some comments came in. Unfortunately, I was so focused on the slides, I could not read them. But I know there was one about Bangladesh. And if you have copies of that, I don't know whether everyone on in the seminar room digitally had an opportunity to read them.
Okay. There was a comment that Bangladesh has a national identity database with biometric information for adult citizens. And SIM cards are registered with biometric data, fingerprints, and authenticated from the database. I've been to Bangladesh. It works very well. If you go to the airport, there's somebody sitting right there with a, and you're buying a SIM card, so somebody sitting right there with a reader. So we've got a couple of questions. Also, there's another comment that there's a study, paper AML CFT regulation for MFS standards approved by the Central Bank of Bangladesh recently. So we'll try to find that link.
Well, that's very interesting. That's something that I'd like to see in the laboratories library.
Yeah. Observatory.
Oh, observatory. I keep on referring to the laboratory because I think you are doing so much magic just on your side, Leon.
Alchemy, yes. Okay. So we'll find the link and push it out to the participants. One or two questions on electronic KYC. You mentioned that it's primarily associated currently with government databases. What about self-sovereign identity, where the identity, for example, is generated by a person and is asserted by someone, and to that point, where that self-sovereign identity is placed in the blockchain? What implications does it have for KYC?
Leon, interesting question. The dilemma, I think there's a lot of promise in distributed ledger technology, also for identification. The problem to be solved for every model is who does the assurance. So who links the data or the identity that's chained to the actual person that you're dealing with. I've seen models that propose, for instance, that is a function that a bank can perform. I've seen, for instance, in relation to a university. And often when we change jobs, we need to provide copies of a degree certificate. And you need to bring it in physically so that someone can cite it, and they then make a copy and they sign it as cited. It's a very clumsy process. If the university that issues that certificate blockchains it, then it is the supreme authority to link it to your identity, because they go through stringent identification processes of all these students. So it could work well in that regard. The problem is, if you move away from a government or such a trusted institution, who are the other trusted institutions that you use to make your sovereign identity work, so that it amounts to more than something that's self-claimed, something that can be trusted by third parties, and always when we speak about AML CFT, something that can be trusted by the regulators and is acceptable to the regulators as something that can be trusted by financial institutions, knowing that criminals will do their best to break through that system, subvert it, and abuse it.